Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. Since 2002, so the end of the dot-com bust, we've gotten used to the technology sector, the Nasdaq 100, outperforming the S&P 500, carrying the broad market higher. A large part of what fueled the bull run since 2009 has been big tech being driven higher as we've had a rapid period of digitalization over the past 10 years and also a period of very easy monetary policy with low inflation that's been able to push these big tech companies to higher valuations. Now, this is not the first time in history that we've seen this type of market price action. Since we've seen this type of development, this type of dynamic in the market, where a handful of big companies outperform and carry the rest of the stock market, we saw this type of dynamic in the late 90s leading up to the 2000 dot-com bubble. We saw this in the late 60s, early 70s. Both of these happened to lead to big tops. The 1973 bull market top that took around 10 years before it was taken out, and also the 2000 market top, where the market also happened to take around 10 years before those highs were taken out. Now, in 2022, throughout this bear market that we've had on the S&P 500, we've seen the technology sector here. This is the performance of the Nasdaq 100 significantly underperform the S&P 500. And we can see on this chart here, if we compare the top 50 to bottom 450 stocks in the stock market, we're coming back down to trend. And so in this video, we're going to take a look at whether this is just another repeat of this situation back here. Not many investors know that 1973 was actually the top of the Nifty 50 bubble back in the 1970s, where investors were betting big on a handful of companies like American Express, General Electric, McDonald's, and IBM, bidding them up to ridiculous valuations on the hope that these companies would eventually rule the world. Now, of course, today we have stocks like Amazon, Google, and Apple that at the peak of the euphoria made up a massive portion of the S&P 500. So is this type of breakdown what's in store for us over the next few years as we see these mega cap valuation stocks bleed and cause the stock market to go into a period of secular underperformance, where going up is definitely not the norm? That's exactly what we're going to be asking and answering in this video. If you enjoyed this episode, don't forget to hit the like button. It makes a huge difference. It is really appreciated. Now, without further ado, let's get right into it. So let's first quickly take a look at the Nasdaq 100 relative to the S&P 500. Now, of course, the Nasdaq 100 had a huge run up during COVID right here. This was March 2020. You can see even as the market was going down, we saw tech significantly outperform during that period. We then formed a double top, broke down below the neckline, and we've been retracing that entire move up that we had throughout COVID. Now, just quickly from a technical standpoint, it seems the easy target for the Nasdaq 100 relative to the S&P is around at this level right here. So another 5% underperformance relative to the S&P 500. But where do we go after that? Are these big tech companies completely dead? Should we forget about them like investors forgot about the Nifty 50 in the 1980s and pretty much the majority of the tech stocks after the dot-com bust? Well, let's take a look. One of the key driving factors behind technology has been bond yield. It's been all about rates. As rates go up, technology typically struggles more, and then as rates trend down, well, that's when you've seen periods where tech outperforms the market and carries it higher. And that's been especially true more recently. You can see throughout 2019 and 2020 here, this massive drop in the 10-year yield. In addition to the pandemic, that was a big tailwind to tech throughout this period, while rates pushed tech valuations to very frothy levels. And really ever since, you could argue, January 2021, where investors saw that rates were finally turning higher and we were coming out of this massive low rate, easy money, low growth environment, well, that's when all of a sudden you had technology stocks underperform. And as we've seen the acceleration of rates higher, we've seen the acceleration of this underperformance of tech to the downside, the breakdown of these technical structures, and really from the moment you broke down this area of support, the massive gap here, just complete hot air made technology stocks vulnerable to downside. And you can see that's even been the case here. Despite the fact that we've had this correction in bond yields, we've actually continued to see tech move down. So there is this irrational behavior that is also happening right now of extreme fear just because of the momentum to the downside. You can see here in August, as we had this stabilization in yields, you did see a nice recovery in tech stocks right there. But that's not something we're seeing today because investors right now are fixated on the fact that rates are going to stay high and that marks the end for tech. For these big tech companies, just like rising rates here in 1973 really popped the Nifty 50 bubble and created that big crash. So at first glance, it does look like we are very vulnerable to this type of collapse as we see all of that optimism that has accumulated in the market throughout the last 10 years really just dissipates out of the market as we see yields continue to rise. Now, if you believe that rates will continue to move higher, and we've said this many times before, if you think that rates are moving higher here, all bets are off for tech's underperformance. You absolutely want to stay away from tech, and you're going to see this chart break down and move lower. That said, we don't think we're exactly in the same situation as 1973. Now, you can see here a lot of people compare the recent rally that we've seen on the S&P 500 right here to the rally that we saw in October of 1973. October 1973 is the exact month of the oil shock of 1973. You can see right here, oil went from around $3.50 a barrel in June all the way to $10 a barrel in January of 1974. So that was the oil shock, and it created a massive upwards pressure on yields in the months and even years that followed the oil shock. By the way, if you're so far enjoying this video, don't forget to hit the like button. We're working on increasing the quality of the YouTube videos, bring you a lot of value, bring you a lot of detail, data, and historical context around what is going on in the market today. So if you're noticing that, don't hesitate to hit the like button. It makes a massive difference. Now, if we look at the same chart today, the oil shock is behind us, right? The real oil shock that we had in 2022 occurred in January, March of 2022, so around 6 to 9 months ago. Inflation has already peaked, and considering the fact that inflation basically follows oil, it's probably going to continue printing lower and lower readings in the months ahead. That's really not the same dynamic as we had in the 1970s. Now, what you can argue is the fact that inflation has broken out means that rates are very unlikely to come back into this secular downtrend that we've seen since the 80s. And so that big outperformance that we've seen since 2002 on tech stocks, well, it's not necessarily going to collapse like it did in the 1970s, because as I just mentioned, we've already seen peak inflation. The oil shock is behind us. So unless we have this second oil shock sends inflation again through the roof, it's unlikely you're going to see this massive collapse of big tech. Potentially more of a secular period of stagnation depending on where rates go over the next couple of years. Also, if we compare the PE ratios of the technology stocks back in December of 2021, well, yeah, they were a little bit more expensive than the S&P 500 at that time as we had that peak in 2021. But if we compare that to the Nifty 50, definitely a lot cheaper than the Nifty 50 bubble, and also nowhere as much optimism relative to the S&P 500. You can see the S&P was cheap back in December of 1972 right here, whereas the Nifty 50 stocks were trading at around a PE ratio of 40. So a huge bubble that was developing under the surface in the late 60s, early 70s, and all of that got popped at the oil shock. Now, if you are interested in knowing how we're currently positioning our model portfolio, what opportunities we're currently looking at to take advantage of, given this very strange and volatile economic and macro environment, make sure to click the link down below and grab yourself the free trial to test out our service. We currently do have quite a lot of bets on different macro plays, like short USD bets, the Chinese reopening, how we're betting on the energy crisis in Europe. And of course, all of that research is highlighted in our macro notes, and we walk you through the trades step by step in our videos and quick and fast lightning reports. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. Now, in the meantime, I wish you good luck on your trading and see you next time.